Hey, all traders, it's Thursday, February the 28th, the last day of the trading month, and this is John Kicklighter, Chief Strategist for DailyFX.com, here to give you your FX market wrap up for the past 24 hours and outlook for what we can expect over the 24 hours ahead and beyond. Now, this particular session of activity was once again quite remarkable. So we are having a pretty good level of volatility, pretty consistently spread out over the week. This is a rising trend over the past 2 or 3 weeks, and it's encouraging because it tells us that with a steady increase in activity, you're likely to have a greater potential for trends. But most people know that greater volatility typically means risk aversion for those assets that have the direct inclination for risk on, risk off. So with that in mind, however, we note that this past session did not instigate a risk aversion based move. So starting off our conversation with the euro dollar, we actually see that there was a positive bearing for the day. This is the first seriously positive session that we've seen in 6 consecutive trading days. So it does start to pull us up a little bit, but is far from a revival of the bull trend that we had since July that essentially broke down through the end of last week. Obviously helped along a lot by the very poor outcome for the Italian election. That continues to loom over the euro, and that's always going to be an uncertainty. Not that the eurozone needed any additional uncertainties, but the financial markets and the media particularly needed a reason to be worried about the euro, and that gave us a reason to worry. But that wasn't the big driver. That essentially, we know what's going to happen with Italy. They're either going to have to form a coalition, and it seems that the five-star movement is gung-ho of and dead set against making a coalition with some of the other policy official leaders. So the alternative is to essentially go for a second election. A second election will draw out the time necessary to put the economy back onto a recovery pace, as well as essentially getting policy in place to maintain and to further the austerity efforts in the country. So it is a very negative outcome there. But it is not one of those things that has a time frame. We like to see countdowns. We like to see immediate threats of loss. That's what starts to move the market. That's what gets these markets moving when you're talking about especially the Eurozone crisis, because traders have become very, very accustomed to problems in the Eurozone. They've had years to get used to it. So we need something that has a countdown to it, and we need something that, or something that really proves that people are going to lose money. That's the two things that really instigate the motion from the market. But the biggest move on the day was not from the euro. The euro dollar itself wasn't really advancing because of the euro itself. In fact, the top event risk in my view for the past session was actually ECB President Draghi's suggestion that he wasn't thinking about withdrawing stimulus anytime soon, was his wording. And that's to be expected, but it certainly does remind us that we are in the stimulus game, and verbal intervention, which is becoming far, far more common, especially in this past session. We'll talk about the RBA in a second, but it's becoming far, far more common, and they're upping their game. And Draghi's suggestion that they're not going to remove stimulus isn't a strong catalyst itself. All right. The bigger mover on the day, and the thing that really drove the euro dollar specifically, and also contributed to other dollar-based performance, as well as the yen crosses, big driver up to up on the dollar yen and the other yen crosses, was a risk-based move. All right. You can see here the Dow, and we also had a similar very aggressive move on the S&P 500. European equities did well themselves, as did Asian equities, but not to the level, not to the extreme that you had on the really aggressive S&P 500 and Dow Jones Industrial Average rallies. So what was driving those particular rallies? Well, actually, just like we were talking about with the ECB president, we had Fed Chairman Bernanke testifying to the House Financial Services Committee, and I wasn't expecting much from this because it's essentially a repeat of what he said to the Senate, and he gave all those commentaries just the day before. But apparently, the market liked it a little bit more. In that commentary, the things that people were potentially looking at and responding to were suggestions that there was a significant majority of the Fed policy officials supporting the current policy, kind of offsetting the expectations, the speculation that the market was generating after the FOMC minutes, which suggested that there were a few and several or a number, those were the words they were using, that were starting to talk about reevaluating more and more stimulus. All right. We also heard that that they didn't think that the housing sector was where they would like it to be. Of course, it's not going to get there for a while. That's not necessarily a suggestion of more stimulus, but the market will interpret it the way that it wants to interpret it, and we have to go along with what they're going with. So with this commentary, we actually saw a very, very significant rally from these equity markets. These are actually futures-based, but the rally actually began with that commentary. I actually put it as red, though, and this is my calendar is tapped into risk trends and the systemic risk elements of the market. So why did I mark it as red rather than the green that you would assume from the performance of the equity markets? I actually mark it as red because I think that the most remarkable thing that Bernanke had actually said was that he would actually be reviewing their exit strategy from their stimulus soon. All right, that's far more different than what we've heard from them previously. We've heard much of the continuous "we are willing to do more stimulus" speech over and over and over again. We're acclimated to that. We're very acclimated to that. So that is why I mark it as a red day. Furthermore, well, you have to assess what the market is doing. All right, you don't want to necessarily fight the market, but we do want to evaluate its strength. So looking at the performance of the equity markets in the backdrop, here we have the S&P 500 and its index volume. All right, and this is volume only of the days that are under 500, or actually 480 million shares. So it's a low volume day. And as you can see, we've been having more and more and more instances of low volume trading, and this past session certainly fell within that range. This is an extremely quiet day, and it's a quiet day on a very exceptional move to the upside. All right, and to give a comparison, this is actually the Dow Jones Industrial Average, but there's similar cut to them. This was the biggest rally that we've seen since this really massive advance that we had right after the fiscal cliff resolution was given at the beginning of the year. So the biggest move in a couple of months on some of the weakest volume that we continue to see in a long time. It's not the kind of mixture that I like to think is a resounding confidence of continuation for risk-based trends. All right, something that we have to keep in context, into perspective. Furthermore, you can see from the risk bearings that I follow along with, the risk-reward index, which is the fundamental components of sentiment, the potential for return versus the level of volatility or risk, as most people see it, compared to the S&P 500. You can see that this risk-reward index is just collapsing. And while the S&P 500 holds off and can hold off because it does find itself in the way of stimulus, you can't get that deviation for too long. All right, there's only so much investment that can be put in, whether it be public or private investment. So, with risk trends in account, you have to assess if we do. This is a 5-year high from the Dow. Is this the kind of push that will extend a rally from the euro dollar? I don't think it's necessarily strong enough that's going to extend a rally on its own, much less encourage risk appetite trends for these further from the epicenter kind of pairs. But of course the euro can have a little bit more inclination here. We'll talk about that in a second. But at the very foundation, don't look for pairs that are not necessarily oversold. If you think that there's at least a stabilization of risk trends, and maybe even a rebound in risk appetite, though looking at U.S. equity markets, I would think that it's relatively mild, look for something that is particularly oversold. The euro dollar is not necessarily oversold. Aussie dollar, a little bit more so. A little bit more so. My preferred trade is actually the dollar CAD, which I am currently short in, because the Canadian dollar is the higher return currency of the North American region. So people with capital, which is a lot of people in North America, can direct it to Canada if they want a higher rate of return, or they want also a level of safety, because Canada fulfills both sides of that role. Furthermore, I think that the dollar itself is individually significantly overbought. You can see here on the U.S. dollar and the Dow Jones FXCM dollar index, it's significantly overbought and is prone to a correction. For that particular play, I think that a nice reversal here from the dollar CAD is a great potential. That's why I'm already short. My stop is actually placed above the swing high. So looking to see how that one plays out, and since it has a little bit better potential, also if you do get a risk aversion move, since the Canadian dollar's been treated more and more like a safe haven, it has greater potential on that foundation. Furthermore, I think that there is another, if you want to essentially have a view on the euro dollar, okay, you can take a position on the euro dollar. You can look for a rebound, but then you have this immediate resistance at 132.50. You break that, you break this tentatively descending trend line, and then you can get into some more of this congestion up here. And of course, the advance can find support. I mean, the easiest thing that, or the most prominent factor that can continue to play into an advance for the euro dollar is the fact that the ECB continues to see its stimulus effort decline. All right, the Fed's balance sheet continues to rise while the ECB's balance sheet continues to contract, and that in and of itself, as you can see here, is a very, very significant driver for the performance of the markets. From a market perspective, this is what it looks like. You have higher yields on European investments, of course. Medium to long term, it's not really improving all that much, and it's not really going in favor of the euro too dramatically. But if that's the case, and you see that the market expects the ECB to stay its path and pull back from the verbalized intervention that so many other policy officials are trying to enact, then hey, the advance from the euro dollars is a good potential. But I don't want to play it on the euro dollar. I want to play it instead on a currency pair that acts almost exactly like the euro dollar, actually the inverse of the euro dollar, and also has much more attractive technical figures. I'm talking about the dollar Swiss. Now, I've described before this relationship because of the euro Swiss, all right? And it looks like a lot of volatility here, but when you look at it in a normal context, it is some of the most inactive markets you've had in a very, very long time. Thereby, the Swiss franc acts a lot like the euro itself. So, arguably, the euro dollar will act a lot like the inverse of the dollar Swiss. And as you can see from the dollar Swiss, it's held its descending channel. All right. If you have an advance from the euro, and the euro and the Swiss are acting out the same pattern, then the franc would advance against the US dollar and subsequently drop back within this channel, breaking this shorter term rising pattern. So that gives you a nice breakout, which looks like it's technically feasible. And if the euro is going to strengthen, then you have that situation as well. And going back to the fact that the dollar may be significantly overbought without a strong risk aversion call to support its continued advance, that too has a fundamental bearing that supports that particular move to the downside. So that's kind of my argument for risk on. All right. Now I've kind of held back from the risk on implications of the yen crosses as well. As you can see here, the dollar yen has actually advanced, the euro yen, the pound yen, all right, the Aussie yen. All of these pairs have advanced back to their respective former support levels, and now treating them as immediate resistance. I actually, in the morning, earlier in the day, Wednesday, took all three positions off. I had, I mean, these were the second halves of the positions that I was trading earlier in the week and took profit on, and I took them off essentially near break even. I think I made 35 pips on the Aussie yen, and I was down 25 pips on the euro yen, and down 10 or 15 pips on the dollar yen. So it was essentially break even for the lot, but I wanted to take some risk off. But I was I was just so interested in the proximity and the look and feel of these technical pairs that I put some smaller size dollar yen and smaller size euro yen shorts back on. Okay, the reason being the technicals are so attractive. Now, there's a significant risk to this. All right, and I was kind of debating whether to completely take it off or continue and hold for the technical bearings alone, because the short to medium time frame, if risk aversion still kicks in, and I think it does have a great chance of, because I don't think that there's a lot of confidence in that move or participation more explicitly, then a reversal and a continued move to the downside certainly weighs on the yen-based crosses. Of course, they need risk aversion. All right, without risk aversion, there isn't a reason to actually go long yen to unwind that carry trade. Why? Because we know that in about a month's time that we will have new leadership in the Bank of Japan, and they are going to be easing at a much more aggressive pace, because that's essentially what the market expects, and that's the assumption that the Japanese finance minister and the Japanese prime minister and the Japanese economy minister are putting, and the task that they're putting to the new leadership of the Bank of Japan. All right, so we know that that is going to be the case. So if you want to get that correction, you need a reason to actually drive it. And risk aversion is the best reason you can get for a carry trade based pair. So that being said, if you do have, even though we know the next nominees for the Bank of Japan, the next leadership of the Bank of Japan, are going to be more dovish than Shirakawa, the current governor, and his deputy governors, who are also being replaced, and they will be replaced on March 19th. The market still is responding as if each new news item is a reason to sell the yen. All right, well known. Is well known. But some of the event risks that you have for the upcoming session, the reason why I was hesitant to add further build the position size on those two yen crosses, or add any other yen crosses which are similarly at good levels, is because we know that there's a running assumption that Japanese Prime Minister Abe is going to announce the nominees for the Bank of Japan replacements. All right. Once again, I assume that this would already be priced in. We already know that they're going to be dovish regardless of who it is, but it was, if you refer to what happened over the weekend, the media speculation that there was going to be a dovish policy member. They named one policy member, Karuda, who is very dovish, yes, but we already knew he was going to be dovish. Nevertheless, the dollar yen and all the yen crosses actually gap to the upside. So you have to respect the risk that could be there, and it's not worth getting large size until you see that event risk pass, and if it doesn't really show an impact on the market, or you can get a technical break to the downside, clearing congestion if you're looking for a new short to actually see it drop below this level. That would be the conservative approach. All right. So risk aversion, the yen crosses are probably the best overall setup. I still have a exposure on the Kiwi dollar short. All right, we've risen right back up to the congestion low, and I've never gotten into large size, but now that we're back up there, I said that I would consider getting short, or I would add potentially to the short side if we did get up to this congestion zone. I'm going to play this cautiously, and I'm going to measure my risk. And if I don't have a lot of yen-based risk, and depending on how the nominations come out from the Bank of Japan, I might actually add to this Kiwi dollar short to kind of balance the sheet on my risk exposure, because I do have the dollar CAD, which is an offset to the Kiwi dollar, and I also have the exposure for my dollar Swiss with an entry order below this this rising channel here, kind of as a long risk, because remember it's a pseudo long euro dollar position. All right, so a lot of uncertainty, a lot of risk, and there's a lot of event risk that's actually coming up. Top event risk is going to be the BOJ nominations, which we'll keep a close eye on. But you also have some other event risk that's coming out. I would say watch pretty closely the Swiss GDP figures, because that's going to determine how aggressive they can be with their stimulus conversation, as well as the U.S. Treasury reporting the foreign holdings of U.S. securities. That's a very interesting measure, and it tells you how much capital inflow or capital purchase is being made, and essentially we're looking at it for treasuries. How much demand is there for treasuries, even though they're at their exceptionally low levels for yields, which is what we'll be looking at. But outside of risk, is there opportunity? Yes, I think there is opportunity. I'm watching the pound dollar. A risk-on situation would certainly help it, but also a stabilization of risk trends and a kind of tolerance or a tepid path going forward of the assumptions of more monetary policy. The Bank of England rate decision is next week, but they're unlikely to actually add to their stimulus because they haven't been talking about proactively adding. We had that big drop-off which was encouraged further by the minutes that suggested that more of the policy officials at the Bank of England, their monetary policy committee, were calling for an increase in stimulus. Now, if that increase in stimulus doesn't come at the next rate decision, expect the pound to actually shoot higher. So that's specific event risk, but it does have its attachments to risk-based trends. I do have a new position, actually, in the Euro Kiwi. We're talking about this being a rising channel, all right? And we came to this descending trend line here, which is also a confluence with a couple fib retracements. Now, it drove up to test this trend line support and then subsequently corrected. Now we're actually getting the first lower low daily bar in 7 consecutive days. So this is actually a good potential for a correction. I took a short, I believe, at 59.20 or 25. The stop's above, about 10 pips above the high. We'll see how far this has to go, but this is not specifically or explicitly risk-based trends. Of course, risk appetite would probably help the Kiwi more than the euro, but both are sensitive to risk-based trends. More so, they're going to drive under their own momentum. So that's an interesting one that gets further away from the risk concept. And if you do want to see a risk aversion move, but once again stick with it, further away from the extremes of risk on, risk off, I'm watching this pound Kiwi potential here. Now that we've bounced back down from this resistance, we are forming an inverse head and shoulders pattern that we have here. You break to the upside of above 84, and it's a good progressional view that we have going forward with this particular pair. So it's a one to keep in the hopper, as they say. I think it has an interesting look to it. All right. So a lot of potential and a lot of trading. I do want to wrap up the FX talk with a big jump in the Aussie dollar. Now this is a remarkable jump, not because of the risk trends. Risk trends absolutely supported it, but it's remarkable that it continues its advance. When we heard this morning the RBA really step up its verbal intervention. All right. It's funny to recall that not long ago, we had the G20 come out and say no one should give or no one should be targeting their exchange rates for competitive devaluation, and essentially that they shouldn't give guidance on their currency. Well, we've heard more and more policy officials give guidance on their currency, and the RBA just this morning said that they believe their currency is 4 to 15% overvalued. All right, you can't get more more engaged in the currency war without actually firing a shot through stimulus than this. It's pretty impressive that they're doing this. I think that there's a really good chance that we're going to have some more intense battles in terms of stimulus and verbally talking currencies down going forward. It's going to be interesting to watch this game. But the last thing that I want to talk about is the alternative to currencies, and that alternative to currency is going to be obviously the gold market. Now, gold is an alternative store of wealth. I'm sure you've heard this of one of its 3 major values, and it's an inflation hedge and as well as a safe haven asset as well. But as an alternative store of value, it's the alternative to currencies, which are very difficult to get away from. All right, you can't really get away from currencies very easily because you really have to price your capital in something, and whether you're buying a government bond or an equity, it's going to be priced in the local currency. So to get away from currency itself, you go to gold. And people want to get away from currency when we have this very loud verbal intervention, when you have a lot of volatility in the exchange rate, it's an exchange rate market itself. And as you can see, the FX volatility has been picking up, but volatility has this past session come down on both instances, both the U.S. equity and the FX market side of things, but it's not really coming back down too far. So you did have that correction, you had that pullback, and it certainly has contributed to a correction, but it isn't really giving us trend one way or the other. something that I think that we really should take a closer look at is actual participation. So gold and total holdings of gold in ETFs, you can see it's starting to come down and change month over month change. We actually have the biggest drop in holdings on record for ETFs and holding of gold. We also seen a similar situation in COT figures, net speculative interest in the futures market. Gold is being cut at the fastest pace we've seen in approximately 4 years. So we watch the day-to-day changes, but keep a closer eye on these bigger patterns. All right, this has a good chance. If it starts slipping below 1525, it could really start moving because of the unwinding of exposure. All right, so a look at risk trends, a look at the FX market, and a look at the broader picture beyond it. A lot's going on out there, but until we have a clear and decisive direction on risk trends, I think that we're going to see a continuation of confusion, but we will have that confusion and direction associated with high level of volatility. So make sure your expectations are set so that you see near-term targets. Take profit along the way. Very important in these types of markets. Good luck trading out there, guys. I'll talk to you once again tomorrow.